Hi, I'm Brendan Casey, General Manager Investments with Rest. Welcome to our quarterly investment update. It's been another fascinating year for global financial markets as talk of trade wars and rising interest rates seem almost at odds with strong corporate profits and continued global growth. Volatility, the ups and downs of investment markets, continue to dominate over the past financial year. After a strong start to the financial year, we saw emerging markets tumble in the last quarter, spooked by talk of US-China trade wars. But we also saw shares in developed markets generally perform well, with US shares being the star performer. Here in Australia, our market showed remarkable resilience, despite a cooling property market and concerns around how our biggest trading partner, China, might fare as trade tensions rise. For the 2017-18 financial year, we're pleased to report a 9th consecutive year of positive returns for Rest members. This demonstrates the strength of our active investment management approach over the long term and the value we're adding to our members' retirement savings. For the year ending 30th of June 2018, our core strategy returned 8.7%, well above our investment objective of 3% above inflation. Over the past 10 years, the core strategy has returned more than 7.4% per annum. For our Rest pension members, the default balanced option returned 6.7% for the same period, again outperforming its investment objective, and returning 7.4% per annum over the past 10 years. Once again, shares made the biggest contribution to returns in the past 12 months, with property and credit also performing strongly. During the past year, we've boosted our property portfolio with a $900 million stake in the Quay Quarter Tower in Sydney CBD. This was an exciting investment highlight that we believe will generate strong net returns for members over the long term. Rest also introduced private equity as an asset class within some of our investment options. This adds exposure to an international portfolio of unlisted private businesses, providing diversification from the traditional listed assets like shares, and offering the potential to access superior risk-adjusted returns over the longer term. Looking ahead, we see more volatility in the new financial year. On one hand, global economic momentum continues to gather pace, and so we believe business profitability will also strengthen. But the turbulence around global trade makes for a less comfortable journey in 2018. The slowing pace of growth in China will be just one factor to watch. We're also seeing central banks around the world making money more expensive to borrow. So as the times of easy money come to an end, rising interest rates may signal more volatility. We see good reason to keep our relatively defensive positions in place. We currently hold around 12% of our core strategy in cash and around 42% in Australian and overseas shares. And we'll continue to look for the opportunities in other asset classes, like property and infrastructure, that offer the potential for returns over the long term. So thanks for joining me for our latest investment update. I'll catch up with you next quarter with the latest news of your super investment with Rest.